Welcome to Wealth Matters Podcast. I'm interviewing Mr. Robert Campbell today. Robert has been eating, sleeping, living, and breathing real estate from the time he learned how to walk. His 46-year real estate career, that includes as a real estate investor, he has bought and sold over 40 rental properties. And as a developer, he has built over 50 homes and apartment units. In 2002, Robert wrote the book Timing the Real Estate Market, which is the only book ever written that shows investors how to predict the peaks and valleys of real estate cycles with 85 to 90% degree of success. So, welcome, Robert. How are you today?
I'm doing great. Fine. Thank you very much. We got a lot to talk about. And people ask me how I do them, and I'm going, great, because I'm always a conservative person. I mean, it's times like this, they don't come along very often, but it's times like this you get to see, as Warren Buffett likes to say, when the tide goes out, you get to see who's swimming with no bathing suit.
Right.
And, you know, these times are long, and you have to be able to survive them financially, emotionally. And that's something you learn after being 72 years old, Alpesh. You don't know that when you're 35.
Right. And we are recording this on 20th of March. As of today, entire state of California has been ordered shelter in peace, a place. Yep. I mean, so and
I'm in San Diego, everybody. I live in San Diego, California.
Right. So, what was your first real estate purchase, Robert?
First real estate purchase was. I believe it was, I think I was like 20 years old. I was getting my MBA at San Diego State. I bought a 6-unit apartment house in about 6 blocks away from the ocean. And I fixed it up as the units became vacant, raised the rent, and sold it a year later for I think a $10,000 or $12,000 profit, whatever it was. And as a 22-year-old, we're talking back 50 years, everybody.
Oh, wow.
$10,000 was a lot of money.
That was a while ago.
Yeah, it was a long time ago. So me being the, astute investor to keep the money growing, and I'm 22 years old, and so what do I do with it? I went out and bought a Porsche.
Right, of course.
Right. What else does a 20-year-old kid do with a lot of money, right?
Right, of course. So, hey, Robert, changing the track here, because I found you from your book, etc. So it's interesting concept. So how does trend tracking work in real estate? I know a lot of people track the trend or momentum in stock market, right? But how does it work in real estate?
Well, essentially, I've been trading stocks for 50 years. So how I learned about this concept was from stock market trading. I was taking a commodities class from a guy named Joe Ross, and he said in Austin, Texas, and he said, markets are markets. And I said, you mean I can apply the same kind of thing you're learning here to any market? Yeah. So I started looking at like 25 key indicators and going back with them using trend following and momentum features. And because I knew what the cycles were here in San Diego, because I was born on a building site, I knew the ups and downs. I found out what key indicators were highly correlated with price movement. And those are the ones I use in my timing model.
Interesting. So, and I have also heard that no one can time the market. So how can you figure out when to buy and when to sell?
What you do is there's just 5 key indicators. And people will tell you that you can't time the market. That's a bunch of BS. I mean, you can time the market. Some people have been very successful. Warren Buffett's really good at it. He's a market timer. But how I do it in real estate is you use forward-looking indicators that have historically gone up or gone down prior to the prices are moving. And three of those, there's 5 indicators that do that. Number 1 is existing home sales. Number 2, new home building permits. Number 3, notice of defaults. 4, foreclosure sales. And 5, interest rates. So if you just follow those 5 key indicators, you'll know when you'll have a 80 to 90% probability that you'll be right. You'll know when the trend has changed approximately 3 months before everybody else. That's the lead time you get. This isn't looking out in the future as a fortune teller. I mean, it gives you it's a forward-looking indicator, so you're going to know 3 months in advance either buy at the low or sell at the high.
Yeah, very interesting. So can you
Yeah, I know.
share?
It's you know what,
Look,
and it's very logical. I mean, once you read the book, if you're common sense people go, I mean, the data is what it is. I show you what all the data is. I run the formulas. I show the cycles for San Diego County and how well the model works, and it's worked with amazing accuracy. I mean, is it perfect? No. Is it better than anything anybody else has? Absolutely.
so you are focused on San Diego County. So can I apply that in let's say San Francisco Bay Area or Central Valley, anywhere in
Oh,
California?
sure. In fact, I track 7 major markets in California. No, I think it's 6, and 17 throughout the United States. So the formula applies to any major market city
Okay.
that has
Okay.
a population of, let's say, 1 million people or more.
Oh,
In other words,
okay.
you need a large sample size to make anything work, right?
Right. Of course.
You
So
can't test 5 guys for coronavirus, get the results, and generalize about what those findings mean.
right. And we will get to Corona today, especially COVID-19. But can you share
Sure.
some examples of how you were able to time the market? If you go back in time and if you can share some numbers or examples, that would be great.
Well, you have to understand, I'm 72 years old. I developed this timing model back in 2002.
Okay.
It wasn't prior to that. That's when I wrote the book and developed the model. So 2000. So that's only 20 years ago. I was, developing real estate, investing in real estate, very heavily and very, very fully involved in the real estate business for 30 years prior to that book. In fact, it was one of my biggest failures in 1990. I was building 2 small home subdivisions, and these are all for my own account, everybody. I don't build for anybody else. I just build for myself. And the market turned down, and I lost a bunch of money that if I didn't, and I said, at that time, I said, all the economists were saying, yeah, everything's good, until it wasn't. Then everybody said, yeah, you should have sold last year.
Right.
So you shouldn't listen to any of those guys.
Right.
Just listen to data, the correct data, the right data, and you'll improve your odds by 10.
Right.
Of coming out with the correct decision.
That's exactly how the recession works, right? They say, you have to have 2 quarters worth of contraction and then they will declare it's a recession. So by the time it's a recession, you find out after 6 months or so that we are already in a recession, right?
Yeah, and we're either coming out of it or close to coming out of it.
Right, exactly.
I mean, how good is that? How valuable is that information?
Right. No, nothing. So what happened with you in 2005 through, let's say, 8 or 9? How did the book or
at that point in time, that's I had developed this formula, and I had a few subscribers, but one of my subscribers I started writing a newsletter. I think I had less than 100 people. One of them said, you ought to write a book about this. And I said, yeah, that's a good idea. So I wrote a book about it, and I've sold 31,000 copies of my book, self-published, no Barnes & Noble, anything, in the last 20 years, or 18 years, I should say. So that worked out really well. But so at that point in time, I started using my brain instead of being a builder. So it was a lifestyle choice. So I can go to the gym more, work out more, run hills more. I mean, I'm the healthiest 72-year-old in the world probably. And so that makes me feel good, but I don't have to be out on building sites. I love building. I love it. I'm really good at it. But when you're building, you got to be on the building site at 6:30 to open up for everybody, and you stay until 4:30. And you know what? To be successful, that cuts too much in my gym time and working out time at this stage of my life. I'm not as motivated to be the wealthiest guy in the world now as I was then.
So, did you do anything in 2006 or 7 or 8 to change your portfolio, or did you start investing or just looking at your formulas?
Oh, well, you know what? I can't remember, to be honest with you. That goes so far back. But I have never been a buy and hold investor, Alpesh. I've always been a buy low, sell high. I mean, as a builder, you create value and then
Right.
you sell it, and then you sell it and you move on. You know that my mantra. That I live by the motto: high speed, low drag, and having a bunch of rental properties, and people to deal with. A lot of people don't realize that maintaining rental properties is a lot of work one way or another. I mean, it may all come at once. It may be you have a good year,
Right.
easy year, then you have a bad year. I mean, as the economy moves, a lot of people don't realize that rents go up and down with the economy. I
Yes,
mean,
of
rents are real
course.
high right now. I mean, but cyclically, in my last newsletter, I told everybody that I'd been warning them of a recession since the yield curve inverted back in May 2019, and I updated it. And all of a sudden, when this virus thing said, I said, "Look, guys, I expect a recession this year, regardless." And then coronavirus came on, and I said, "That just accelerated its arrival." To
Right.
start using common sense things like that, following just a few key indicators, as long as you're an experienced businessman, right?
Right. No,
You got to be wise. I mean, could a
that's a great
35-year-old
point.
do what I'm doing? Probably never in a million years.
Right.
He hasn't seen the world, right?
And exactly. And I'm only 42. I'm 30 years younger than you, and I don't have, of course, as much expertise, but I have been warning everyone since early 2019 that recession will hit in 2020 or 2021 at most, right? And I don't want to be like, I told you so, but just the
You don't
coronavirus
have
has acted as
you
a
don't have to.
catalyst, right? It has
Right, the
acted
people
as a
that care about
catalyst.
you. Oh, because I put everything out there in my letter, and I'm completely honest about everything with all my followers, and that's one of the big reasons they love me. I don't hedge my bets. I tell them what I think. It's all backed up with data, and then everybody has to make their own decisions based upon their
Right.
own individual circumstances. Some people may disagree with me, and they may not they may not follow what I suggest doing, but nevertheless, they still want to know what I'm saying. That's what's interesting, right? They know what I have to offer has value, and whether they use it to their advantage or whatever they do, they want to know about it. But not everybody follows me to the T, that's for sure. But most people don't take instruction very well. Things like fear and greed get in the way.
Right. No, it's not easy, right? And then the way I look at it is because I'm buy and hold investor, right? Everyone has a different investor profile. They have a
Right.
different risk tolerance, right? So, someone like me who picks and choose, right? Chooses the advice I want to go after or I want to, apply to my investment philosophy, right? So, of course, but you would end up sharing no matter what, right?
Oh yeah, see, even if you're a buy and hold investor, the biggest financial advancement you could give yourself as an investor is to buy when real estate prices are low and depressed, right?
Of course, always. You have to buy
After
right.
that, right. Buy low, even if you don't sell. I mean, then all of a sudden you say, you know what? I'm going to start getting rid of some of my properties. I mean,
Yep.
at some point in the next
Of
10 years.
course.
Would you
Yes.
rather sell high than sell low? Then you use it to your own temperament. I
Yep.
mean, and other things come in the way too. Sometimes your goals change. So all of a sudden you meet
Uh-huh.
you get divorced or something like that,
Right.
or
Yeah.
I mean,
Goals change. Like my daughters now go to college, right? And it's about time for me to sell the properties to pay for the
right. I
college,
mean,
right?
when you need. What most people do is they invest their money when they have it, and then they take it out when they need it.
Right.
Do you think the market cycles respect
No.
what you? No.
Never, right? That's why we saw the 401k slashed 70-80% in '08 and '09, and lots of the workforce housing had to go back. I mean, workforce had to go back to work, right? Who were 65 plus, 70 plus, because they didn't
Right,
have
and
any
all of a sudden,
money.
if you think, okay, here's some of the money that I need for something for sure. It's money needed certain, and you have, let's just say, $100,000 in your 401k, and you're going to need 25 of it. All of a sudden, your 401k drops down to 40,000. You need 25 of it for an expense, college,
Right.
whatever, business, whatever the thing is. Now you almost have zero left, right?
Uh-huh.
I don't think that was the plan.
No.
And,
So,
and that's what makes this all such a fascinating game, by the way. I find it exhilarating because to a large degree, nobody knows what the world's going to be like in a year or two. I mean, you can have some idea that, study that the best way to determine the future is to study the past, but
right,
still, that's not even perfect. It definitely gives you clues, but it's so fascinating that this is what everybody has to do. And is it a lot of work? Yeah, it's a lot of work staying ahead of a changing pendulum. But
right,
it's what you have to do to make it in life. Because most people at the age 65, only 4% of all people age 65 are comfortable financially. Only
right,
4%.
right.
All these
I
people make it
agree.
seem so easy, like just giving away money in stocks or real estate, or you know what I mean?
Uh-huh.
No.
So,
it Everything goes ups and down. And see,
yep.
I'm here in California, where the real estate cycles are the most extreme.
Yeah, they're the
For one
most
thing, and
extreme in coastal market, and of course, California, as we have seen. So, I have a question, right? Another question I have is regarding this cycle, and we were going there. So, of course, you think the recession has hit, and let's assume that it's we are kind of or recession is starting. How and why do you think that this expansion cycle lasted the longest? Because it was like the longest expansion cycle, right? 10 plus years. Um, why did that happen? Of course, government pumped the money, but can you explain?
well, that's a debatable point because data can back up a lot of different viewpoints. But I would say that if I had to make my best guess would be it was cheap money.
Right, of course.
I mean,
Lots.
and we live in a debt-driven society. I
Yep.
mean, and that's what's driving the markets crazy right now. You have 8,000 hedge funds. All those guys are super leveraged, trying to
Yep.
enhance the returns. They take something that's a small return and and put 10-to-1 leverage on it or 15-to-1 leverage on it. Now all of a sudden it becomes a decent return and everything's fine until the market turns and the asset falls 5, 10, 15, 20%. Now they have margin calls. And they
Yep.
got to
Yep.
sell the asset and they got to sell everything else. And that's basically what you're seeing right now, right? That everybody's
Yep.
making all this money based on low priced money, and a lot of it. Now all of a
Yep.
sudden, that's fine as long as assets are appreciating.
Right.
But all of a sudden, the tide turned, and now these guys are all out there swimming without bathing suits, and they're
Yep.
selling everything they can, just to meet their margin calls.
Right, and it was everything was so because of cheap money, everything was so overpriced that
Right.
we
Yes.
all knew
Right.
that this was coming, right? Just that a lot of people ignored it, or a lot of people did not care about it.
So
So,
there's only three things that I have a degree in economics from UCLA. And what I've learned over the last 50 years since I graduated is there's only three economic principles that have any real value. Everything else is either theory or BS. One of them is the law of supply and demand works. We know that.
right,
Two, no economic free lunch, which is what they're kind of doling out here. And number
right,
three,
yeah,
everything returns to normal. I mean, is
yes,
are zero interest rates normal? No.
no,
It's going to everything in life returns back to normal, or everything would go spinning off its axes. That's just the way it is.
right,
That's the way the world works. The assets get too high, then they start falling because of fear, and they get too low. Then they want to start returning back to a fair, and then they get too high again. And because what drives the cycles? Human behavior. I mean, what's human behavior all about? Simple: fear and greed.
right, of course.
And that's what we have right now. We're in a cycle of fear.
Yep.
People say, "Oh, this will go away." How do you know
Right.
what the hell
No one
people are
can
going to do,
predict.
right?
And so I'm going there actually. My next question is because now we are seeing, before we decided to get on the podcast, we hadn't seen the coronavirus impact, but now that we are seeing a lot of impact on the stock market, and of course, not only just the stock Wall Street, but also manufacturing industry, oil and gas industry, etc. So what do you see? Again, none of us can see the future, but what can you predict right now that what will happen in real estate world as well as Wall Street in near future?
Well, I could say this. I mean, we're in a recession right now. There's no question about it. 10% of all workers are unemployed.
Yep.
That could be worse than a recession, right?
Yes. Oh, yeah.
So that's going to affect things for at least the next 2 quarters. And after that, people talk about, you hear this pent-up demand. Oh, there's all this pent-up demand. No, there isn't pent-up. You lose your job, and all of a sudden, and let's say you get it back, let's just say 2 or 3 months later, and when you lost your job, you couldn't afford to make your mortgage payments because you didn't have any money. The case with most people. All of a sudden, you get back to work, you owe 3 months worth of past due mortgage payments. You think people are going to be able to come up with that? I mean, you better have a solution for that problem too, right?
Right.
I mean, so I think I'm leaning toward the money drop. I think the government's just going to start handing out money, which I mean, they're doing it anyway.
That's what
I mean, you might as well just right, sending people checks so they can at least start, because you just can't postpone your taxes or your rent or something like that, because when everything gets back to normal, whenever that is, and it's not going to be in the next 2 weeks, you're going to owe a lot of back rent and a lot of back payments and all that kind of stuff. And you have a lot of people have zero income coming in right now, and even people that are in business, their income's been reduced dramatically, like let's say 25%. So I mean, this is American economy is shut down right now.
Yeah. I would say global economy, right? Because it's everything depends on America and China right now. So overall, everyone's
when you have a lot of debt, which everybody does, those debt payments don't stop just because you're running through a rough patch, right?
Yeah. And that's why they are doling out money at 0% interest rate, because America also needs to pay for their debt, right? So it's good for them.
You still owe the debt.
So,
well, see, then you have other problems. I mean, that this has all been building up for a long time.
Right.
You know, we have a pension crisis.
Yep. California pension funds is another problem, right? Social Security.
They're underfunded. Yeah, what's your solution for that, right? So you know what they've done in Chicago? In Chicago, they raised, over the course of the last 3 or 4 years, they raised property taxes, 2 different raises, 25 and 25%. And guess what everybody in Chicago is doing?
Migrating out.
They're leaving.
Yep. So I guess I was looking at it. The highest migration ratio is in Illinois, the number 1 state. Then second is New Jersey, and third is California. Right.
Because these states have lived beyond their means for so long, you know, because of corruption and free lunches to buy votes and all that. All of a sudden, the day of reckonings come when they got to start making the payouts, and they don't have nearly enough money, right? Everybody wants to give out free stuff without having to pay for it. Now they can't afford to make their payments, so they have to start, taxing everybody. This is exactly what happened to Detroit. Chicago could turn into another Detroit.
I agree. And so I have one more question, and which is again related to COVID-19. What do you see post-COVID era, right? What will happen? How do you anticipate real estate market? Do you think it's going to residential real estate is going to crash like we had a crash in 2008 and 9?
Well, I'll tell you this. That my indicators and my brain work on like headlights on a car. I can see down the road, but I can't see around the corner. And neither can anybody else.
Great. No one can.
Real estate was accelerating prior to the invasion of this virus.
Right.
The year-over-year rates of growth were going up in the United States, not so much in California. See, my timing model gave us.
For last 2 years, California hasn't moved up much, but before then, for 5 years, it was doubling, right? So
now we're underperforming. So, how this affects, this isn't going to help. I'll tell you that. People aren't going to rush to buy super high-priced real estate in California after they've lost their job, or that may be a risk they have to think about. So it's definitely going to cut down demand, right?
Right. Supply and
demand. And some people, if you lose your job and own a house, I mean, what's the first thing you're going to do? You're going to put it on the market.
Right. Yeah.
Gee, there goes all
Foreclose, short sale. Yep.
right, all this low supply stuff goes away. I mean, as fast as this happens, this stuff could change in the next, 3 months real quickly.
Right.
So people just panic, and people panic and go, "I want to sell," and everybody wants to sell. All of a sudden, the market gets flooded with inventory. All of a sudden, inventory shoots up. Demand, takes a dive, and all of a sudden, now prices are going to start falling, and they could fall fast from these levels.
Yeah,
right?
we have seen that,
especially with the recession. I mean, the recession is going to hit everybody, right?
Right.
What happens during recessions? The unemployment rate goes up.
Right. Yeah.
I mean, is that conducive to a positive mental attitude about what's going to happen in the future, thereby that you should probably buy a house right now? No, it's just the opposite.
Right.
So what a lot of people don't understand and recognize is that markets are driven 60 to 70% by psychology, fear and greed.
Yep.
I mean, you can look at the cycles in the past, and that they're going to give you big hints about what the cycles of the future are going to look like, because human nature hasn't changed, and that's all you can do.
Yep, I agree. So
in other words, I tell people, if you want a guarantee, buy a toaster. Otherwise, play the odds.
So what is, with your experience for last 45 plus years, what is one advice you would give to the real estate investor who is looking to, let's say, buy or sell properties in next 3 to 6 months? What is one advice you would give them?
In the next 3 to 6 months, I mean, I'd like to go back and not put any time limit on it.
Okay.
The biggest advantage you can give yourself as an investor, and we've already talked about this, is to buy real estate when it's depressed and the prices are very low. And those times come around about once every 10 to 12 years.
Right.
And people go, "Oh, that's too long." You know what? Those times are worth waiting for, guys.
Right, I know.
You only have to hit 2 or 3 or 4 cycles in your lifetime, and all of a sudden you're 65 years old and you're doing really well. I mean, money isn't going to be your problem.
So you think that is around the corner? That kind of time is around the corner?
Yeah, I think definitely California real estate speak, not the U.S.
Right.
Chicago's getting close.
Yeah.
But I think that, and based on past cycles, I think that the down cycle in California will probably last 6 to 7 years and hit bottom around 2026.
Oh, really?
And that's just looking at the past. That's just looking at the past, because that's the only, you can look at the cycles, how long they've lasted. And most people don't understand the cyclical thing but they do take time. You don't have these extreme volatile movements in real estate like you do in the stock market.
Right.
Like in the stock market here, that, I even use timing systems on that. The market's dropped like 35% in a month. My information uses monthly information. By the end of the month, it'll give a sell signal after the market. I mean, to get out after the market's already down 35%.
Right.
I mean, that's how fast things happen in the stock market. They don't happen that quickly in real estate.
No, because there is no liquidity, right? It's not easy to liquidate. And the second thing is you are not attached to as much emotionally as stock market, because you can watch it daily, right? Not even daily, it's by minute. So, of course, there is a faster reaction.
Real estate, I'll tell you that if we hit a situation here where, let's say, that this economic downturn gets real bad, and that's not a low probability. I could see that being like unemployment hit a 50-year low. Remember my comment? Everything returns to normal. What's normal? Like what, 6 or 7%? 6%? That's a lot of unemployed people right there, and a lot of them own houses, and a lot of them are going to hit the market. And the business is going to go down. People's incomes are going to go down. Real estate people, during good economic times, a real estate person, let's just say, may average $100,000 a year for 5 years. Now we get in a downturn. You know what his income's going to be? 50 or 60.
Right.
So if he went out and bought a big house to show the world what a great success he was, he's in trouble.
Right.
Because most people don't have any cash reserves.
Yeah.
We know that.
That's true.
60 to 70% of all Americans basically live month to month. So
Yep.
all of a sudden, this thing goes on for 2 or 3 or 4 or 6 months or whatever the case may be. Who knows? A lot of people are going to be in trouble.
Yeah, I agree.
I mean, so if you own a house or you need the money, what do? You do what they're doing right now in the stock market. You liquidate, right?
Yep.
Well, I still have, 200,000 in my house or 300, whether, I'm going to sell my house, and get all that money out. So you call your broker and you said,
Right.
hey, my house, and your broker, and when that's what everybody else is saying. So the broker says, to who? The whole mood of the market can change. You know what I mean?
Right.
So people want to sell, they don't want to buy. And so that's where the psychology comes in, and it's really interesting. But you have to recognize that that psychology is there. It's not based on, it's based about 30% on fundamentals and 70% on market psychology.
Right. So we'll change the track. I have some more questions. Any website or apps you use for your real estate purpose? Do you recommend anything other than, of course, your own website?
Well, I mean, I've been doing this so long, I have data sources coming from everywhere. I explain them in my book to a large degree. And once you know where they are, you can do your own research, because your data has to be specific to the city you live in. You can't get data for San Diego and apply it to Las Vegas, for example. So, and I follow so many cities, and real estate data isn't like stock market data where you can take it back 100 years and you've got it day by day by day perfectly. Real estate, data is really, and some places don't track it very closely, and other places are tracked very closely. California, for example, is tracked very closely because it's the biggest state, and it has and real estate's a big attraction here because it tends to appreciate faster than the rest of the country.
Biggest state, largest GDP, Silicon Valley. You got Beverly Hills, Hollywood. So of course.
Yeah, we have a lot of rich people.
Yeah.
We have a lot of rich people. Like San Diego has the best weather in the United States. California's in a beautiful location.
Right.
I don't so much. I like Southern California because I'm a beach boy. I was raised on the beach, and you know what? It's a real moderate climate, and that's what we all pay for over here.
Yep.
We're close to the ocean, and the climate's really good.
Yep. So any business
that costs money nowadays.
Any business
that costs almost as much. that costs almost as much money as a 24-roll case of toilet paper.
Right. Yeah, I'm not going there yet. So any business or
my wife has sent me to 2 different stores on 2 days to pay paper towels because I work out of the house. Both days they've been sold out, and I said, nope, I'm not going anymore. Right. I said, send the kids. They're out of work. The 2 of them lost restaurant jobs, right? They're just out of work. There's and so we don't know you don't know how this is going to play out. As we discussed before the podcast, we talked about tracking hurricanes. Are these hurricane trackers pretty good? Yeah, they're pretty good. But can they tell you where the hurricane's going to be 30 days from now with a high degree of certainty? No.
Right.
They don't, because a lot of things can change, and that sucker can move 500 miles one way or another, which is a big movement. And so all you can kind of do is that almost until it hits, do they know exactly where it's going to hit?
Right.
You know what I mean? But they keep people alarmed. They go, looks like it's going to hit here, and if that's the case, you better get out. And it's almost the same with real estate timing. Right. If you think we're going to if the recession is going to be a real bad one, and all of a sudden, that you were thinking about selling your real estate or you think now's a good time, you bought it at a good time, you can make a big profit and weather the storm successfully. You have to think like that and say, okay, now I'm going to sell it. But you still have to be ahead of the crowd. Wait for everybody to come to that conclusion. Correct. Now you're late. And it's always better to be early rather than late. Even if it's right, and that's what gives you an advantage as by following key indicators where you can have a high degree of certainty about what's coming, like recession. I just didn't have a dream one night, and I'm sure you didn't either. Those key indicators. My key indicator is the 90-day T-bill minus the 10-year Treasury note.
Yep,
anytime
and that's a big one.
Only one I follow because it's always right. The last 7 it's preceded 7 out of the last 7 recessions. So are you going to bet against that? No.
No.
You have to be an idiot.
So my last question, Robert, any business or real estate book you recommend?
No, just my own. I've read all the books, and most of the books, for one thing, most of the books are for buy and hold investors. I'm not a buy and hold investor, so I'm not an expertise in property management and all that kind of stuff. That just kind of bores me, frankly. I'm more interested in the excitements of the month to month, the year to year changes in markets, because and the money aspect of it, And I know from a fact, people think, there's no magic to buy and hold investors, making money. I know plenty of buy and hold investors that buy high. They think they're buy and hold. Here's what they do. They buy high. All of a sudden the price crashes, and all of a sudden we're going to sell at a profit at the peak. They miss that, so now they're going to hold it until it gets back to an old peak. And here in California, that can be 8 to 14 years until they get back to break even, depending on when they bought it.
Right.
They go,
I agree.
Oh, I mean, that's not successful investing.
Yeah.
That's about as bad as it gets. So you got to know that kind of stuff. You should always factor timing into your decision making. Always. Is there any way that good timing can't help you make better decisions? No. So you find a way. You find a way to do that. It's just like so that's why I believe people have to have systems. It's like if you count cards in blackjack, you have an advantage over the house. You do. Right. You will win. You will win. And so you need that. And you say, well, how do you know what cards are coming up? You don't. But you do have there are ways to calculate mathematical odds about what's left in the deck and that kind of stuff. Right. And you can adjust your bets accordingly. And in the course of 30 days, if you play blackjack every day for 30 days and use this system, I mean, how many months during the year do I think that you'd lose money? My answer would be 0. I mean, just because the system gives you that kind of edge.
Right. So how can my listeners, I think we are at the end of the podcast. Thank you. How can my listeners reach out to you, Robert?
They can reach out to me. They can go to my website, realestatetiming.com, just like it sounds. Real estate timing, no dots or dashes.com. You can buy my book. You can subscribe to my newsletter. You can read about me. I have some blog post stuff and things like that I put up occasionally. And so that's the way to make contact with me. But I would recommend everybody read my book. I mean, you're going to read. There's no way you're not going to like my book. If you like, giving yourself an advantage in markets.
Absolutely. So thank you so much, Robert. As always, I had fun chatting with you.
Thank you very much, too. Thank you for having me. I really appreciate it.